All right, good afternoon, everybody. Event Trader here. We are about to start up the latest edition of the Sentiment and Flow Show. So, just want to welcome everybody in this afternoon. Scott just gave us a nice run around on the markets. We'll continue to follow information as it comes through, and if there's any big moves, we will definitely alert you to it. But first, wanted to welcome in chart trader Brett Manning. Brett, how are you doing today?
Doing pretty good, Gavin. How are you?
Pretty good, pretty good. So we got a lot of stuff to talk about today. Certainly, some of the moves in the dollar that we've been flashing in our last couple episodes has been taking hold. Obviously, the gold trade's been working out nicely. But before we break into that, Brett, we wanted to take a look at you replied to a feedback at 1410, and it's going to make for a nice little learning episode for us jumping into this before we get into some of the nitty gritty details. So uh, I'll just read out the question so people are aware if anybody wants to follow along. This was the 1410 comment by chart, and then I'll let you break into it, Brett. But basically, the person was
Okay.
asking, they were curious how Brett and other traders react mentally to situations like the Nasdaq's today. And I'll pull up the Nasdaq chart for us right here. The Nat He said, I find that my mind is more discombobulated after this type of situation, bailing early and then standing on the sidelines watching a nice winner, than it is after taking a larger loss when my initial stop is hit. So he's talking about two different trades there. It's like I can visualize the pile of money that is not on my desk but should be. It's a dangerous attitude, I know. What have you found to be the best way to fight it? So Brett, you answered it, but you could go into a little bit more detail here.
Sure. So yeah, I mean he's referring to a Nasdaq trade I put on this morning, and then I bailed out of it. It didn't get anywhere near my stop, but I said I wanted to reevaluate it. I was looking for something slightly different in terms of how it played out. And then of course here it goes launching over about 100 points above where my entry was, and again without getting close to my stop. And I understand where he's coming from. If you go through that experience, you can, sort of take that exactly how he describes. You can visualize the money that should be in your account and isn't. And so my answer to that question is, and the question really is, how can you condition yourself to not let that get to you? Because he's right. It's dangerous. It's really dangerous if you give yourself an emotional beating for that kind of experience. In fact, in my framework, it will destroy you as a trader. If you have this, and I certainly hope this individual takes this to heart and realizes how dangerous it is. I think that if you have that type of experience, or you're prone to feeling that way after missing an opportunity that goes without you, the inevitable consequence of that is it's going to change the way that you deal with the market in the future, because you don't want to experience that pain again. And the way that it will change you as a trader is universally bad, because it means you're going to end up taking setups that you don't necessarily love because you're afraid of missing it. And so the way to deal with this and to really break it down and understand the sort of key concepts at play here and how I deal with it is there's two totally separate ideas. One of them is directional bias. Okay? I knew the market was going to go higher. That's just a fact. The other aspect of it is setup. They're two, I think, completely unrelated ideas. I need both of them to line up to take a trade and to stay with that trade. And in this case, I was a little bit impulsive with my entry, and when I took a look on a larger time frame and I just broke it down in my mind, I realized that the setup wasn't there. Even though I thought the market was going to go higher, I didn't have a valid setup, so I got out and I waited looking for a valid setup. The reason why it wasn't a valid setup is as soon as I took a closer look at it, I realized I felt strongly that there was a high likelihood of the market taking out the tails on a short time frame that were underneath the 11,115 area, roughly. One more shakeout down to take us down to maybe the 11,100 area or the 11,105 area. I thought that was probably a really likely way this pattern would play out before breaking out higher. Now, it doesn't matter whether or not that happens. The point is, I realize that if I'm in that trade with my stop at 11,108 and it goes and hits my stop, obviously that's exactly where I want to be buying. That's the perfect setup. So as soon as I'm put in that conundrum, that's it. There's not a setup. The only way to deal with it would have been to widen my stop back another 20 points. Now, here's why it's not a setup, because my inside target was a flush of the previous highs of the range, which was around the 11,150 area. So if I'm risking 20 points from 11,128, and I think we're going to run stops through 11,150, maybe hit 55s. As those orders cascade, there's my inside target. That's more than a 1-to-1 ratio. That makes it a valid setup. Second, I've got to be risking 40 points on that from 28s. It's no longer a valid setup. So I'm perfectly satisfied with my reasoning there. I'm perfectly satisfied not being in this. On an instance by instance basis, I really don't care. What I care about is the next 6 months, the next 2 years, the next 5 years. I know that I have a system that works. So all I have to do is make sure I stay with that system, and I allow myself to be happy about making a decision that has a probabilistic large sample reasoning to it that matches up with what I know is going to work for me over the next 3 years, rather than beating myself up for this one trade where I was right about the directional bias, but according to my experience and everything that I've learned in 20, 25 years of doing this, I didn't have a valid setup. So just that knowledge means I'm not the least bit upset about watching it go. It isn't about this trade. It's about the next 100 trades. It's about the next 1,000 trades, and having a systematic approach that does two things. One, it gets you into situations where both your directional bias and setup line up right, and you take advantage of those. And it doesn't ever put you in a situation where you start to get confused about what it is you really believe about markets, because you can confuse yourself. If you beat yourself up for missed opportunities, that becomes like a malady in your mind. It will change the way you look at things. It will contort and pervert your reasoning when you're looking at the market, because you're going to start seeing those gains that you wish you had rather than seeing what's actually happening and whether or not it matches the system that you want to use. So that would be my answer. I think just having the ability to say, hey, here's my large sample probabilistic understanding about what the right framework for making decisions in the market is, and then being happy when you stick with it, regardless of what the market does.
Yeah,
There's
no,
the elaborate answer.
yeah, no, I completely agree with you, Brett. I think the key takeaway, as you said, was that your system is an effective one and it works. And you'll miss a big one from here time to time, but you're never going to get burned too badly on the downside. Now, I mean, how close did it come to triggering your stop, your 20-point stop?
Nowhere near it at all. Right. I got out right around the level I got in a couple points off. It got maybe 10, 12 points away, but not even quite halfway to where my stop was. But even that wasn't really. It wasn't about whether or not I got close to my stop. It was just I realized where my stop was is where I wanted to be buying. And that was a setup that made sense.
I think it does matter a little bit to a degree, Brett, in terms of I think you dropped out of the trade quickly because it wasn't acting the way you were hoping to. I think one of the worst things is if you're starting to get close to your stop and then you just decide to ditch it, figuring, well, I'm save my 3-4 points. And then and then it runs away in the direction that you were looking for. How do you avoid that?
Right. That's a different phenomenon. I mean,
right.
If you believe in the setup, then your stop is your stop. Now, if you get meaningfully into the money, then it comes back, then it waffles around for half an hour, and you start to look at it, and you can basically say to yourself, this is a changing situation. This is no longer the same setup. Perhaps your directional bias shifts. You may ditch it under those circumstances, but in this case, it had nothing to do with what the market was even doing. It's just that I panned out a time frame and realized my setup was invalid in the first place. I just basically been impulsive on the entry. So I got rid of it and waited for a setup that matched what I was actually looking for.
Do you prefer using time versus levels in terms of trying to figure out when your setup is missing? Like you just said, you'd given it a certain amount of time, but the levels weren't too much of a factor. Is there a certain level that you kind of have as a red flag before it hits your stop that you try to set up? For instance, you're risking 20 points, right?
That was the problem, Gavin. I mean, I think that we're talking at cross purposes. It's not that I started to not like the setup. It's that I realized I had jumped in without having a setup. And when I realized I got back out. And so I know what the setup was. It just didn't ever appear. I had a directional bias, which was correct. I had a very strong feeling about that directional bias. I felt extremely convinced that we would run 11,150s. I felt there was no chance that we wouldn't, based on everything that I was watching across every major asset class. The primary overall leader of all risk assets on the planet was holding up better than everything else, and I could just feel we got bad headlines coming through. We got the Senate just giving up on the whole stimulus bill. Tries to break down, can't. Microsoft and TikTok tries to break down, can't. You're just in this situation where you're just piling up this inevitable cascade of orders above 11,150. So there's my directional bias. It's in place. It's rock solid. Now we turn to setup, and I really just looked quickly at a short time frame and said, there's a flag here. That's what's going to bust. That ended up working. That was the right setup. But the second I looked out a little bit further, I realized that the setup would be much, much better if it shook out one more time under the tens, right? And the only way that I had positioned the other setup was to say, that's right where my stop goes. So that puts me in an impossible situation to be systematic about how patterns are important to me more than time or levels. And the pattern was one shakeout away from being an ascending triangle breakout pattern with a shakeout already in place and a bunch of new people sucked in short to squeeze out when we go through the highs. So there's no way I want to be selling at just under the tens. And that's exactly where my stop was. So I'd have to move my stop another 20 points out, and suddenly the ratio doesn't make sense. You see what I'm saying?
Yeah, no, I see exactly what you're saying. So,
okay.
All right. Okay, so that's definitely a good learning lesson for us to kick off this discussion here, Brett. So let's take a look at some of the things that's happened since we talked 2 weeks ago. And I think really one of the biggest stories in the market that we've talked a lot about, and that's the breakdown in the dollar. The last time we were discussing it, I'm just going to pull up the Dixie chart here. We had been talking about the 200 weekly moving average and the 50-day monthly moving average last time we had spoken, and that if it broke this, and that was around 96.50, that we could see a steep decline. It had both of us in the gold play that we've been in for a few months now. And
let's not forget the new fiscal latitude in the EU as being a big part of that whole picture.
Right. Yeah, exactly.
We got a new leading reserve currency probably in the not too distant future.
Yeah, I mean, especially if you're looking at a trade war between the China and the U.S., and we'll break into that. But the euro certainly did their fair share of backing a single currency for the first time in its history. Now, it still has to get through 27 parliaments first, Brett, right? That fiscal bill. So we don't want to
27 different languages, 27 different bureaucracies.
Exactly.
Yeah,
so I think that's going to be a real key point in our discussion here, too, because, again, for people unaware, the euro makes up about 56% of that Dixie basket there, so it's certainly a significant influence in what we see. But let's talk about the dollar first, Brett, and I want to kind of talk, I think most people have their ideas on the reason behind the weakness, but I'm curious, if you're handicapping this, do you think where do you stand in? And I don't want to have you break up put you on the spot and be I think it's 13% this, 20% that, but we obviously have the fiscal policy out. And questions on whether or not even the fiscal policy could get in. So I'd be curious as to your thoughts. What do you think is the bigger item for the dollar, fiscal policy passing or not passing? And, of course, then we got the monetary policy, and then we got the political uncertainty coming in November. So let's kick off with probably the most immediate thing, and that would be the fiscal policy that's facing us. Where's your thought process on the current stance of the two sides, and how do you see this playing out in a little game theory?
So my firm belief is it will pass. There will be a new fiscal package. I suppose we've reached a level of such political dysfunction in this country with everything coming into the head, and we've got the twin echo chambers so bloody at war at this point into the election that maybe, but I really think what we're seeing right now is a very kind of type specimen, high-level negotiation process where, the end stages are made of threats to walk away from the table. Like, that's just the way negotiations work. And we're just seeing a lot of it. And I put like a joking kind of tongue-in-cheek Brett's Law of congressional debates or negotiations maybe yesterday in my notes, which was basically, when you see an increasing density of tactics being put out in the press. In other words, Pelosi says, forget it, we got no chance. And then Meadows says the same thing. And, whenever that starts happening more and more and faster in time is probably when you're getting closer and closer to a deal. So that's kind of been my heuristic for evaluating these sorts of things. So I don't see why this would be any different. Now, I suppose if they feel like both sides can somehow lean on the idea that there will be the most immediate pain in the real world for people, there could be some temporary bridge to let them negotiate the details out further. We tend to see that sometimes. So I guess, what are your thoughts on that, Gavin? Do you think that it's possible that whether through executive order or through some other emergency kind of simple bill, a scaled down version, we get past the time pressure of, 40 million people basically being in a situation where they're homeless and can't eat?
Well, yeah, obviously the unemployment insurance tax, or stimulus, I should say, is the big item that people are watching for, right? That's probably the most immediate. If we see that fall through, then there's certainly an uptick in concerns around defaults around credit cards,
Right,
mortgage
but
payments,
my
auto.
question specifically, do you think that there could be so I think this negotiation could go a lot longer if they could pass a temporary patchwork emergency something, whether through executive order or through Congress.
I
Do
don't
you
think
think that's likely?
I think it's likely. I
You
I I,
do.
I do. I do.
Okay,
And
then this negotiation could go on a lot longer to fine tune the
exactly.
rest of it.
That
Yeah,
and
that's a
I
very possible path.
Yeah, it's a very possible path, and I think it's so. I mean, the one thing that we've seen, the most interesting aspect for me, is kind of been the GOP sideline for this, where we even saw a comment from McConnell saying that if President Trump and the House Democrats can reach a deal, that there's the potential that the GOP Senate would back that. Now, obviously, in addition to these high stake talks, we got that November election. And I suppose,
That's funny though, right?
yeah,
Yeah.
so I suppose the most likely scenario for it getting past the full vote, that is without the support of those 20 GOP senators that have basically staked their reelection on not backing it, looking to be the fiscally prudent people, and the White House and the Democrats striking a deal. And I'd be really curious as to see what kind of fallout there would be for that in November. And I also wonder if we start getting a little bit closer, if people start whispering in President Trump's ear that if you're cutting a deal with the Democrats, there's no way you could get reelected. And that's, we've heard time and time again how everything's all about President Trump looking to get reelected and how that's what he's made his decision. So I'd be real curious to see how that would turn out. And we'd have to keep an eye out on polls on whether or not the GOP base, which we know has been firmly behind President Trump, would agree to such a deal. And I've got questions about that. That's why I think that we could run into an area where they have to pass the unemployment insurance. I think we could see it fall into the Democrats' favor of the $600 weekly. I know it started off with $200 and $600, but then we've already seen the GOP move to $400. I think the Democrats hold all the cards in that particular negotiation, particularly given the voting that's going to be going on with anybody that loses out on that unemployment. Brett, you've already talked about how people are a little bit more okay with the modern monetary theory being passed. So I think that can certainly get passed. And then we would move forward into longer negotiations. I would probably stretch out past beyond the elections. There's no immediate bankruptcies on the cruise front or on the airlines front, so I think that we could see that extend out past the elections. Now, the only way that I don't see that happening is the GOP or is the White House and the Democrats striking a deal. And that I think we got to really closely watch the polls, because I think that's what Trump's watching on whether or not he wants to strike a deal. And that's the big outlier for it. How would the GOP constituents view a deal that the Democrats struck with President Trump. I think that the White House does want to do it. I think what it comes down to is what they think the perception would be on it, and whether or not that would be the death knell in any type of reelection. So,
So I have to. So I think that an interesting piece of analysis I read not too long ago had to do with really kind of going back in the sort of mental time machine to the 2016 elections, and we kind of forget, I think, about what really took Trump to victory. We have a lot of narratives that we've kind of clung to about this process, and we've invented a lot of them, but a lot of it at the time was more moderate, less politically vocal people, particularly in the suburbs, particularly people like, let's say white women with college educations, ending up being sort of okay with Trump because his kind of persona during that process, it's totally changed now, but during that process was that he was a political outsider who was a deal maker, and he would be willing to do deals with Pelosi or whatever needed to get done, that there was political log jam going on in Congress, in Washington, D.C., generally speaking, and that this outsider could come in and just kind of make deals that weren't necessarily partisan biased. And that narrative has changed completely since he's gotten into office, but that's a big part of what built a coalition for him. He had his strong, base of 30% that, like he said, he could go shoot somebody in Times Square and they would still love him. But he built a coalition between that and other groups, and that coalition was built of being willing to go out and be a deal maker that wasn't partisan about everything. And I think that the idea that he might be able to move and get something done straight with the Democrats in the House, if the GOP Senate is actually willing to sit back and say, we'll go along with whatever he does, we don't want to take a stand on anything, then I think that puts him, that might be a step in the direction of trying to tighten the race a little bit rather than the other direction.
yeah, that's a good point. And like I said, I'll be real curious because he watches the polls, he watches the sentiment indicators out there, certainly the news. So I'm just waiting to see some. And I think we need to see a little progress on the idea that this is being made so people have a fair understanding. I don't think that the average layperson really knows what's going on with the negotiations outside of the Democrats and Republicans hate each other. So I think that'll be a big item. But back to the dollar discussion on this, Brett. What do you think would be the bigger positive for the dollar?
Yeah, it's an interesting question. I think that sort of the dollar is moving, I think, on larger time frame ideas. I said this the other day in my notes, and I said this a couple weeks ago when we did this, and before that, that the big thing that's happening right now, the most important thing that's happening right now, it's not about what happens this weekend or next week. It's just from a decades-long kind of idea, we're changing our concept for what money is right now. And the virus is getting us past it. It's just steamrolling over our taboos about, how tightly the concept of money needs to be tied to strict standards, or is it completely flexible in terms of supply? And by having this crisis to deal with and the extraordinary steps that we've had to take, my statement the other day was that, the genie is out of the bottle at this point. It's never going back in. Each step in history over the course of centuries, there are steps like this that happen where that genie gets a little further out of the bottle. It's way further out of the bottle now because of what's happened over the last 6 months. And it's not going back just because we get past the virus. So I think the big thing that's happening right now is really that we're just getting over our taboos of probably, in my opinion, eventually about direct monetization of debt. But I think that a lot of these concepts are in play right now. And I also believe, generally speaking, that in an election year when there's a kind of populist backing behind the administration, you have a lot of unemployment, you're going to see some kind of resolution that's about making sure that in an election year we get money to people. It's free money. Free money is always going to be popular. So I really think there's no way that any politician is going to want to really be on the record with saying, hey, you don't get your check, your life's not okay, vote for me. So I think it's going to end up moving in that direction, regardless of what the sort of presentation of the battle is right now.
Right. And keeping with that theme, too, one of the things that we've seen, I don't want to say it's picking up because I know we've talked about it for a few years now, Brett, and it seems to be like the slowest burn going. And that it was a story earlier in the week that the Wall Street Journal put out about a possible change in forward-looking guidance by the Fed on this price targeting that John Williams first put it out. I think he was still the San Francisco president when he first put it out. Um,
Mm-hmm.
but I haven't seen, it's been a pretty slow period where I guess we're coming up to Jackson Hole. I don't know.
We saw a piece the other day from CNBC saying that they're going to move. They're thinking about moving to what they're calling average price targeting.
I,
So yeah,
right,
so basically, or average inflation targeting, which is a step toward price targeting. If you think
right,
about it.
right,
The idea
exactly.
being,
But
for anybody who doesn't understand, price targeting is the idea that things haven't. If we've had low inflation for a while, then we need to have much higher inflation for a while to offset that, so that the changes in price of anything that would have happened had inflation been at target for the past period,
would
it will
happen.
catch up. It should be at that price. If something was a buck, it needs to be at a buck 10. If we had 2% inflation over a period of time, then if we have less than 2% inflation, it's going to lag that, so we have to have extra inflation to pick up the speed of that price change to get it to a buck 10 at the target point in time. So saying we've got an average inflation targeting means that you're still taking some bit of the past inflation and then figuring that into where future inflation needs to be. So you're basically saying if we have slower inflation, we'll need to raise the inflation target for a period of time to make up for that.
Right. And I guess a perfect time to unveil this again would be Jackson Hole, but I haven't
Yeah.
seen if that's going on yet. I don't think the Fed knows if it's going on yet. Obviously, it would be a virtual conference at this point, but have you seen any updates on that?
No, not at all.
Yeah,
It may
yeah,
be in an
neither have I.
election year. Maybe it's subdued. Maybe they get it out through other channels. I don't know.
Yeah, but I would guess that would be a perfect
I agree
channel
with you.
for it to do it. And I guess the question is, how does
Or
that
maybe a trial
factor in?
balloon.
Yeah, yeah, certainly a trial balloon. Well, I thought the Wall Street Journal article was in itself was the trial balloon, right? I mean,
And the CNBC piece. Yeah, right.
yeah,
Sure.
we know they love using that, but I don't think it had as big of an impact just because I feel like this has been a slow burn, this concept and it coming into fruition. And I think most people feel that maybe it's probably already here. And at this point, it would just be a lip service if the Fed said
Yeah.
this. But
Well, that's kind of what I'm in that camp, I think.
yeah, yeah. Well, I guess the thing I would use it for between the potential for a stimulus package and the potential for this new forward-looking guidance, how does that factor into your trading as we go into August, which tends to historically be one of the more volatile time frames? And I'd also like to back that up with your general thought process in terms of how we could see this play in for support.
Well, I mean, you've seen it. Like my directional bias on things should be pretty clear.
Yeah.
Like, my positions are variously in and out. Long euro, long oil, long gold, long stocks, short dollar. So it's basically the denominator's moving on everything right now.
All right. So we have that as a backdrop. Now, I guess, so again, we're continuing with the dollar discussion here, Brett. I'm going to pull up just a longer term chart of a monthly chart of the Dixie here. And, one of the levels that I think jumps out at us is that 88 area. We hit that last time back in around January of 2018, February of 2018. Now, from my memory, Brett, I think that big downtick to the 200-day moving average, that came right around when Mnuchin made those dollar comments at Davos. Am I correct in that?
You mean the pivot to the upside?
Uh, no, the drop in the dollar index to its 200-day moving average down to that 88 area back in
Oh, the
early
recent drop.
2018. No, no,
Oh,
I'm talking about 2018. Back in 2018, that's the multi-year lows, right? That was the lowest we
yes.
had since 2014. And if I recall, that was right around when Mnuchin was making those comments on the dollar at Davos, right? Where he kind of slipped up a little bit and said that they were okay with a
Yeah,
weaker dollar for trade.
right. You're talking about what sent the dollar index down to sort of capitulate that wave down.
Right, exactly. So,
Yeah, I think you're exactly right. Yeah.
right. So, but I mean, that is the key level that I have on my radar. And I think probably a lot of traders do because we haven't really seen that support come in for the dollar yet. But one thing I wanted to throw out to you, Brett, and I'm curious as to your forward thinking on the dollar. So I think we were both in agreement that we see it go down a little bit lower, but how it gets there could certainly remains to be seen. And one of the things that I was seeing was the current deviation from the dollar on a historical basis right now. It's at a three-time deviation of its 200-day moving average. So it's a three standard deviation below the 200-day moving average, which usually historically has been a strong buy signal for a counter trend rally in the past.
Oh,
Um,
I think it's getting to where, yeah, I think this is going to be one of those difficult trends because but currency trends are like that.
they are.
Everybody gets on the same side, and it has to get to such an intensity before you get that counter trend movement. Currencies, like commodities, trend more regularly than equity. So for people, if you're listening and you're not that familiar with actually trading in currencies or commodities, and you're used to the stock market, currencies and commodities, when they start trending, there's large, long time frame things that start happening. They're in ranges and then they're trending, and when they're trending, usually those trends can carry on a lot further than you think.
Right, and we're certainly looking at a potential downward trend. I mean, just looking at the monthly, you could see, I mean, 88 sets up as a key area because that could also mark a little bit of a channel between 88 to 104 potentially. You could make that argument. 88's really where the breakout was back in 2014, back in 2015 when we had that big dollar rally there.
I got a question for you, Kev. Can
Sure.
you pull up the euro on a monthly?
Yeah.
Can you do a 6E?
60 minute.
No, 6E
Oh, it's
for the
60.
euro.
I got the dollar euro here on it. I
Okay.
do not have the 6E euro, but
Okay.
but
Do you have a monthly chart?
I've got the monthly chart pulled up right now.
How far back do you show it going?
I show it going back to 94.
Okay, so do you see this trend line in the euro?
The downward trend line that could potentially be broken.
We're right coming up to it here.
Yeah, yeah, no, that's funny. I had actually
Goes
pointed
back.
this out
Yeah.
yesterday.
Oh, okay, great. Yeah, it goes back, what, 14 years, 13
Yeah,
years,
I mean the
a
great
lot of
financial
P's.
crisis, right? I mean,
Yeah, I mean, if we're
April of
busting through that
2008,
thing,
we got
then yeah,
yeah, off to the races now. But again, Brett,
right.
27 languages, 27
Oh, I know.
parliaments.
Oh, I know.
Needs to
There is a
be
bureaucratic
unanimous.
blockade there. I
Needs
know.
to be unanimous. And you can't tell me that some of these guys wouldn't like to curry favor with President Trump, perhaps, and disrupt things. I mean, there's, and again, that just goes, and it doesn't have to be a final thing. It could just be something in
Hmm.
the press that leaks that Austria isn't going to pass this,
Sure.
or
No.
one of the northern economies you would think like a Sweden or Norway would be the culprit because obviously they're more fiscally frugal. But
No, I'm not talking about next week. I'm talking about what we're going to see over the next 5 to 10 years, I guess. And there's going to be lots of speed bumps and obstacles. I just feel like there's an inflection happening now in currency markets that's going to be with us.
And I would agree with you on that. I guess for my purposes, just looking for more immediate trading. And again, that's why I kind of brought in that three standard deviation below the 200-day for the dollar.
Hmm.
And this big trend that needs to get through significant resistance. And just a couple of headlines that could shake us up here. How would you be preparing for an abrupt counter trend in the dollar, a big rally in the dollar? Obviously, gold would probably get hit. The oil would likely see. We're already seeing oil kind of struggling a little bit, trying to get above its 200-day moving average. Um, how would you position a more immediate term trade in that scenario? And how would you, and I'm talking equities too, because obviously equities would be impacted by any bounce in the dollar. And what levels would you be ready to strike on the thought process of here's the pullback we wanted. I'm going to hit this right now.
So I would love to see it become an emotionally intense pullback. And I would see that as my job is to be patient, let that type of thing play out, and then position myself strongly across a number of different ways to take advantage of the other side of that pullback, that it would in fact be a pullback in a trend destined to continue. I'd like to see it get emotionally intense. I wouldn't be reading that as far as levels. It would be more about the nature of the movement, to start to see a bunch of people who are short dollar really start to panic out the other side, really see some shifts in maybe CFTC data. I'd like to see it take a few weeks. I'd like to see analysts come out and start to say, news of the dollar's demise is greatly premature, or whatever. I'd like to see all that sort of stuff happen. I'd like to see a cultural context form around the counter trend bounce in the dollar down and all of these other assets, and use that as a positioning basis for some longer term joining of a trend that I believe is probably going to continue.
Right. And so
subject to change. I'm subject to change. All my opinions are subject to change, and it really is. If I see something that changes my view, I change my view. So
right,
but that's where I'm at right now.
And we've been talking about this inflation trade. We talked about how nobody had inflation on their radar at all months ago, and we're starting to see that start to slowly creep up. But it's never going to be a clear path for it, and I think just being prepared for that abruptness is what we need to be looking for, and that's kind of why I'm just throwing you headlines on what do you think is the bigger item for the dollar in terms of fiscal passing or not passing, and then of course this euro move too. Now you've been pretty active in gold. That's been one of the popular calls from our site here the last couple of months. It's been doing well. And what's your current thought on gold right here? Just looking at the GLD, obviously we got that coming up to that 200 level. We're looking at the continuous for gold here, which is now on the December contract, right? We're up right around, we're starting to sniff around the 2100. So any key levels that you'd be looking for in gold on any potential moves?
So again, just like I said with the dollar situation, I'm more looking for a mode of behavior that I feel has become overly aggressive or overly emotionally intense on the upside. And I feel like this is a steep move. And if you look at it on a monthly time frame, it looks like, my God, this is a parabolic advance. But if you really drill down, you look at a 60-minute chart or you look at a daily chart, it's a steep trend, but it's a very steady grinding move. And we don't see a lot of exuberance showing up in things like CFTC data. We don't see a lot of celebration. We see a lot of sense of like, wow, it's amazing how much gold has moved up. It needs to consolidate or correct. But, the beautiful thing about gold, and I've said this before, and I'll say it again, and I'll maybe put it on my tombstone someday, is gold does not have gold. The price of gold is a completely arbitrary idea.
Yep.
There is no price at which it doesn't make sense. It's maybe the only asset in the world that's really like that. And people start thinking, well, it's gone up so much. Who's going to stand against it? How can you say it's overvalued relative to what? It could be $2 million an ounce or $2,000 an ounce or $2 an ounce. Those ideas matter not a whit in the world. The only point you get a little bit of fundamental force is when you get down below the cost of production. And at that point, you start to have some basis for saying, hey, is the price too low? People can't even produce it at this price. But at a certain point, you start to have to say to yourself, well, we know about how much of gold is in the earth. And if we start taking out the idea of we're going to go to meteorites and take gold from it, really, whether you take gold out of the earth and put it in a basement somewhere, or you just leave it in the earth, what does it really matter? Because it's not something we use up, really. I mean, very, very little do we use it up. Mostly we put it in different forms, in different shapes, and different sizes, and we stack it somewhere. And what does it really matter whether it's still in the ground? So it's got a value, but it doesn't have a fundamental tethering to anything. So that's, in my experience, gold can, when it starts to move, nobody's going to stand against it, because there's no point where you can put a research report together that says, this is the wrong price of gold. It's gotten out of hand, like you can for, say, Tesla stock, because you can look at its discounted cash flows over the long term, understand how profitable the company is going to be. At least there are metrics. At least there's a theoretical basis to value a share of Tesla. With an ounce of gold, it could go to $2 million an ounce. It really doesn't matter. There isn't any basis for that. So when gold tends to trend, it can really trend out of control because people have an instinct to start to look at a kind of reversion to the mean, and eventually they can get steamrolled by that.
Yeah,
So
and
I just wouldn't stand in front of it, and I want to see it get exuberant
and and
before I sell out of it.
and Brett, just to build off of that, I don't know if you saw the sentiment trader from Jason Geppert. He had a pretty interesting look at gold and silver, where they talked about gold actually tends to rally more when it's in this type of mode than it does when it's discounted. So, you could definitely see those sentiment peaks in gold really just fly out of control. And the other thing too that you have me thinking is maybe that's another reason to get long SpaceX, just or Virgin Galactic or something,
I know. I've thought about it.
just to fly out and mine gold if it keeps going.
I mean, at a certain point, it becomes economical, right? At what price of gold does it become economical to spend billions of dollars on a spaceship to go out to the asteroid belt and ship it back,
It could be like
and just, right?
Bruce Willis in Armageddon or something. People on.
But again, what if we just say that asteroid is our gold vault? We now own it.
Yeah.
Why build the spaceship? Does it matter?
Yeah. We've got that anytime we want to go into. So,
Hey,
all right.
we'll just say we keep it there. That's where we keep it, is in the Kuiper belt.
Okay, well let's circle back around then, Brett, and obviously this dollar conversation we're going to have for the next couple of months. This is going to be the big thing in the markets the next few months. Let's take a look at some of the sentiment data that we've been getting in the stock markets in general too. So, looking at the AAII data that came out, we saw the bulls come in at about 23.2%, up from 20.2% the prior week. Most of that gain was taken from the neutral territory, which came in at 29.1%, down from 31.3%, so down about 200 basis points there. And then the bears, relatively steady at 40, down a little bit at 47.6% from 48.4%. But
the big picture,
you always
where are we?
Well, yeah, you always love going from that AAII bull ratio number.
Well, I'm just saying, we're at a major bottom. According to the bull ratio, we're at a major bottom.
Yeah.
We're at a panic low right now.
Yeah,
so,
exactly.
I mean, people, what do people really think about the next 6 months in the stock market? Are people really exuberant about it going to infinity? Not according to this.
Yeah, but I mean, you still got the threat against the vaccine coming into the upside, at least anyway.
That's what I mean. Exactly. Yeah. If we get, God forbid, much better than expected news, and people start to really believe in, how great the world could be a year from now, imagine the panic that could still come into this market on the upside.
Yeah, and now some of this, obviously, we've talked about the weaker dollar. That's inflationary for equities, so that certainly helped boost here. It's protection against downside there, so that's playing in. But one of the interesting aspects, and Scott and I have been talking about this on audio for the last couple of weeks, and I know we were talking a lot about it in our last flow show as well. And that's some of the areas that's an extreme optimism that's really not showing much caution to the downside, most particularly in the put-call ratios we've been seeing, Brett, right? And certainly the robo.
Let's circle back, right? So this is our conversation. Might as well be a rerun.
Yeah.
Because in probably the last 6 sentiment flow shows we've done,
yeah,
we've covered the odd dichotomy here. Any options-based sentiment data looks like we're in a euphoric mania. It's March of 2000, and anything else basically doesn't really confirm that. And it could just be that there's a lot of new market participants with small accounts, and this is not a great idea, but who really are levering up with the options market, and that's distorting the options data to some extent. But it doesn't show up necessarily across the board among market participants.
Right. And that's being played out again in the robo, the option speculation data that we've seen, and the VIX as well, too. So that bears watching. Now, Brett, you do all your trading in the futures here, but you've got somebody managing.
Not all, but the vast majority.
The vast majority. Do you have any thoughts of protecting the other side of your portfolio, your long-term investment portfolio? Obviously, probably your 529s for the triplets. 3 kids going to college at one time isn't going to be cheap, I assume.
Oh,
Although,
I've still got the segmented situation we've talked about. So I've still got half of my capital is in the hands of another manager who is
right.
long only, very low turnover in mostly a broad array of risk assets, mostly concentrated in equities.
And,
And that I don't have stops, I don't touch it, I don't ask about it. And that's a decision I made in the middle of 2016 when we reached some crazy historic levels of bearishness across the market.
right now, but with that in mind, do you have any thought processes of protecting that
Hmm.
portfolio with some put buying? I mean,
I
obviously it's
hear
cheap,
you.
so I'm just
Every
curious.
day I have those thoughts. Every single day I have those thoughts.
Okay, so
And
but
I
you
just
haven't
get through
pulled the
my day
trigger.
by not doing anything about it.
Yeah, fair enough. Fair, and that answers my question there. So as much as you're tempted to do it, you'd prefer just to hedge with your ability to shorten futures and stuff to protect
I
against
just think of
downside.
that genie being out of the bottle, and the virus is a temporary factor in the economy,
Right.
and the genie is not. So there's a. I said this the other day, and somebody asked a question about it, and so I had to clarify, and I want to clarify for everybody. I said it's the early party stages of irresponsible monetary inflation, and I had previously said we need to be building this bridge to get through this process, and it's worse to risk a deflationary depression that could last the next decade than probably it is to go through this. That's a terrible set of two choices. But the one that we probably had to choose once things turned the way that they turned, um, it still puts us in a situation where probably we're not going to be able to put that genie back in the bottle, and it's just a sort of, it's just a consequence of the flow of history. I mean, we are now in that situation where we have had to let the genie out of the bottle and ask it to grant us the wish of getting through this pandemic depression risk. But that doesn't mean that we're going to find a way to just go, okay, we're past that now. We're going to put all our prior taboos back in place. When we have other problems, and we don't know how big they are in real time, and all we have to do is make some money out of thin air.
Right. And since you're just on that, Brett, I'll just direct us to one of the feedback questions. Somebody's asking, what do we mean by direct monetization of debt? You want to handle that one?
Well, yeah, I mean, it is, debt being created by the government, money being spent by the government that is then created after the fact, basically through purchase of debt by the Fed, and not as a temporary process, but as basically we're going to make the money that you need to spend. So really, it just becomes a sort of de facto system of money losing meaning in terms of any relationship between, economic production and spending.
Right. And a perfect example of this is basically you'll see the term the Japanification of America, and Japan's basically monetizing their debt.
They have been the vanguard of
Yeah,
this process.
yeah. To put it in the easiest terms, the government spends it, the Fed prints it, and nobody's the wiser. So, and again, it goes to that modern monetary theory that people are of the thought process that governments. The general thesis of MMT is that government creates wealth by running deficits, because if they're running the deficit, then somebody else has to be on the other side of that ledger with the value in their hand. And
Sure.
that's basically the 30,000 view if you're trying to simplify what modern monetary theory or direct monetization of
Well,
debt
and the
is.
idea that as long as interest rates are below the rate of inflation, then it's fine to do whatever we want. But, at a certain point, even according to MMT in theory, you get to change the way you're behaving if you get an inflationary problem. However, the question is, did we just go through a decade or more than a decade of becoming so inured to the idea that there's only one direction this can go, which is deflationary, that we have put in place a number of different constructs that allow us to find justifications and rationalizations to shift our concept of money and the policy around money, so that we pretend that, yeah, we're sure we're going to suddenly act responsible in a situation when we're presented with that risk. We'll know exactly where to draw the line. We'll know exactly how to handle it and put things right if we end up with an inflationary problem, which doesn't seem historically to necessarily be what's happened in the past.
Right. Okay, and then the other question was fiscal deal already incorporated in the prices of equities, and we have a small but quick correction. I don't think that we've gotten a fiscal deal fully priced in equities myself yet. I think that there still remains some doubt on the size of it. If we get closer to the to the Democrats' program, I don't think that that's priced in. Brett, what's your thought on that?
I
Is it?
mean, I don't know if the price matters.
Yeah.
So the idea, I mean, that question comes with a sort of, it's predicated on the premise that, there's a particular price that fully values the market with the existence of that deal. And I don't know if the market's operating necessarily along those lines right now. So maybe wherever it is, the deal's going to be announced. We're going to get a spike up and then probably sell the news. And then we'll see after the fact where the dust settles. I think it's possible we'll get a mean sell the news. A lot of people jump in short and then we grind right back up because it's just another signal of the sort of context that we live in right now.
All right. And then, Brett, moving back to equities here. Curious as to your thoughts on the amount of money that's been put into making it a little bit of a top-heavy market here. There's been a lot written about the gains of the big five FANG
Yeah,
names compared to
right.
the rest of the S&P. I think tech's now something like 32% of the S&P at this point. Um, while energy is down to like 1%. And I suppose you could argue maybe some of the names aren't all tech names, what have you, but still, it's without a doubt a lot of money being concentrated in a couple of areas. I think
Without a
Apple
doubt.
Apple is now what, 17 or it's $11 away now. We talked about the inevitability of this being hit, but that 467 level marks the 2 trillion for Apple, right?
I love the idea of look how long it took to get it to a trillion, and then how long the next trillion took.
It was like 5 months, right?
After how many decades to get the first trillion of market cap, and then the next one comes in a few months. That's
Yeah,
amazing.
just amazing. But what's your thought process and the high-low ratio if we're looking at other red flags? That certainly
Mhm.
continues in, and we've talked a lot about that. You got the regulation backdrop, but I don't think anybody really thinks that they're going to regulate what's now the U.S. global winners. Um,
There's the point right there. So my answer would be you just gave my answer. My answer is that people think of it as a market breadth problem, and I think of it as an economic breadth problem. I think the stocks may be actually trading pretty rationally in a world where monopolies are completely possible, because the rule set that we have really has to do with the world as it operated in like 1908, and we really don't have the resources or the paradigm to understand what monopoly means in terms of the way these companies operate in this world as it works today. And until we change that, I think you can get a concentration of economic value in a small number of organizations, each of which becomes larger than even a large country in terms of its balance sheet.
yeah, yeah, and we got the Apple chart up right now, Brett. I'm thinking we might have 467 before the bell at this point, at this rate. So yeah, I mean, now for you for concerns with the amount of money that's concentrated in the top, do you have any? I know you just noted that it's more of an economic idea than anything
With a
else, but
regulatory issue, I mean, yeah, there's the big silver bullet for this bull market, I think, would be some kind of reorganization of how the FTC understands the concept of monopoly and chooses to pursue it as a regulatory matter.
well, and it's funny too because probably the one thing that both sides could agree on would be against China and for regulation on these big tech,
You're
and
exactly right.
and so obviously putting tech at the forefront for the next 3 months on what's
And
going
there's
to
the
be an
literature's there. I
aggressive.
mean, as I understand it, there's several years of research by really smart people who've come up with theories about exactly how to make a legal case to say that something like Amazon should be broken up, and nobody's willing to grab that and run with it.
No, not at all. And I guess how do you handicap this risk to the markets going into
Yeah.
those November elections, or do you think people are just so tone deaf to it that they just look at it as just commentaries to get elected, and there's no real teeth behind it?
I think that, like with anything, generally speaking, the movement would happen upon the onset of something that everybody identified with a crisis. and then suddenly everything would move. It's just hard to understand how this slow creeping process that's taken a couple of decades to gradually get us to where we are could become something that's manifest in a way people could easily identify as a crisis, and that's the cause. So if political action takes crisis to do things that on their face seem to be risky and maybe even though popular in a populist kind of way, unpopular in the hit that people's 401ks would take, possibly a lot of job losses, who knows what, who knows how difficult it would be to get through that minefield and actually to the other side of it where we had a system that might actually be better over the long term. And the cost of that and taking those risks, particularly for people in elective office, usually you'd need to be pushed to a crisis, and a crisis identified with this problem, and then it becomes, there becomes a kind of consensus political will to do something about it. And it's hard to understand how this overconcentration of economic power in a small number of organizations that can just keep on buying up every good idea in sight and integrating them into their own kind of global portfolio of assets and IP, like how that can become something at a clear moment in time that's easily identified by most people as a crisis, and a crisis caused by that problem. So I'm not really sure how you get there. Maybe we'll find out, but it's difficult to see how you get past that hurdle, and otherwise we just kind of continue with the status quo.
All right. Well, Brett, so anything that we have not touched upon that you really wanted to bring, any concepts out there?
I mean, there wasn't a lot of sentiment in this sentiment and flow show, but that's because the reality is it's the same data.
Yep.
It's saying the same way. We're moving, but we're still in this same situation where the options data is contradicting the other data. So in the big picture, and one thing we didn't get to is so my sort of trauma-driven inflation idea in oil, I've said I think that can apply to lots of things. In other words, that there's an aspect of all assets and of all markets that's a little bit clenched for the next deflationary power turn when we get a second wave of the virus and we have to shut things back down. And because of that, there's this continuing process of risk aversion that's going to be there until post-vaccine reality. And that's always going to cause this probably contradicting set of data around sentiment data, because there's always going to be this sort of protective layer that we're never willing to fully put everything on the table over any kind of asset here, because there's always that sense that we're dealing with this historic downside catalyst that could kind of rear up and take everything over again, just like we saw a few months ago. And you've got a PTSD around that that's going to basically drive behavior. So I think that it's difficult to get to a sentiment extreme of exuberance with that in place. So we're kind of limited in this narrower range, and you're not going to find a lot of big signals coming just from sentiment data. So that may be an excuse or a justification for why we do a show like this and not talk all that much about the specifics of sentiment data, because it's going to be this kind of contradicting series that ends up with sort of a net neutral idea.
Yeah, and Brett, one last thing before we end the show here. Somebody's just asking with respect to the commodities and their daily volatility, do you take trades which are counter to your longer-term bias? For example, nat gas or crude present two pictures on a daily basis. How do you deal with it? So I guess the person's just simply asking, and we're talking a little bit about this with the idea that it's not going to be a clear path for the dollar down, and there's potential for some reversals. Do you like taking that, or do you prefer just trading with the trend?
So I will take those situations, but only if I see what looks to me like an essentially perfect kind of setup. I will definitely take a setup that really works on a very short time frame chart, because I can identify my risk. That's built into the concept of the setup working, is that I see where setup to me is a concept that is defined by knowing really easily and really clearly exactly where I would feel like I'm wrong if it went there. And if that area is close to the current price, in other words, the risk space there provides me a basis, a sort of close wall to push off of. And I see that, and I start to watch the order flow, and I feel really compelled by the idea that I'm at least going to get a certain amount in the money that gets me to kind of inside target, and I can tighten my risk further. And then it's really just kind of, I put myself in an advantageous overall position where I call it a power position. If I get myself into a power position like that, really tight risk, trade in the money, who knows what's going to happen, directional biases aren't perfect. If all those other factors are there, I'll definitely do that. But it has to be a situation where I feel that way about it.
All right, so I think we're just running up on an hour here, Brett. We got about 30 minutes until we get a busy afternoon of earnings once again here. So just kind of recapping everything that we talked about. Certainly, we spent a lot of time on the upcoming fiscal policies that are in place, a discussion around the monetary policy, and perhaps the key game being here, what's the impact on the dollar and inflation? Because I think that is really the big story that we're going to see into the end of the year, really in 2021. It's not discounting the vaccine or anything along that with the virus, but um, the vaccine and the virus issues are going to play out with the backdrop of this dollar and perhaps maybe overheating an economy if we flip the switch back on with the vaccine and things start going back to normal, or perhaps hopefully keeping an economy afloat that's going to continue to see shutdowns as a prevalent source for it. And that's such a big backdrop for us that we just really need to hammer home the details of that and what direction we're going with the dollar here and the knock-on impact for commodities. We discussed that, and equities as well. So, what would you like to add to the just as an overall wrap up to this conversation here, Brett?
Well, so the implicit subtext of this conversation, as with any other conversation in the market, is what Gavin just mentioned there, which we haven't even talked about because there's no point in really talking about it. Of course, every single thing for every single asset will be determined by the future course of our relationship with this virus. And we don't know that. We can't handicap that. We can't analyze that. It's going to go like it's going to go. We can do a good job of trying to say, here's what looks likely, but everybody else can do that too. There's not a real point in us doing a whole show about the virus and how devastating it could be, how devastating it has been, and the likelihood of a vaccine, and et cetera, et cetera, et cetera. That will clearly be the most important factor in how everything goes. And so when you take a base case of like, well, let's say the basic culturally accepted framework right now that seems to be driving Wall Street on a lot of levels is that a vaccine is very possible, even if it needs a booster shot. We're moving forward. We've got maybe 14 really strong candidate possibilities for vaccines. Several of them are already in phase 3 trials. We've also got monoclonal and other forms of antibody treatments, which drastically reduce the likelihood of death, or at least in theory, and can be given to people in early stages, particularly in assisted living centers, which should gradually reduce the case fatality rate for the virus, so people become less afraid of it even until we get a vaccine. Those factors are kind of there. They're somewhat in the market. But obviously, if we learn something new and devastating about this situation, and all the vaccines all fail in their phase 3 trials or something, it's going to change everything completely. So, but if you go forward with a certain set of basic assumptions about what seems to be the case, then the major issues, just like Gavin said, become about the dollar, become about policy, and I think specifically about the likelihood of the types of policies that we've started to become comfortable with through this process, continuing to be tools, new tools in the tool set forever forward, and what that really does. I mean, it's kind of a super steroided up kind of Fed put comes into place. And the market may be trading on some of those ideas and some shifts towards some more inflationary forces. And again, the situation with oil, we've got a lot of producers, and this extrapolates out beyond oil, but we've got a lot of producers who are way behind the curve already. I think we need to have the rig count quintuple just to catch up to be even with what demand is doing right now, and yet every week the rig count doesn't move. So you've got a flood of possibilities to the upside and lots of different things the moment we start to get comfortable with the vaccine being here. And so on the other side of that and all throughout the process, you got this risk aversion.
Brett, do you think the rig count not being able to move up, do you think maybe energy players are just having a difficult time finding loans from banks?
I don't. I think that I think that to expand your production capacity is a fixed cost, and I think that they all believe that if they take that cost, they're going to also have to take the cost of shutting it back down. And there's a lot of players that have been through something. A small oil company, what they went through in April, is just a heart attack. And after you have a heart attack, you eat really well and you're really risk averse and you really watch out for lots of things. I think that they're just on the other side of that kind of experience. So they're making very conservative decisions. They're not going to invest a lot in expanding production capacity right in front of a second wave shutdown that plunges the price of oil back into negative territory until we get to the point where they feel that demand levels are stable. They're rising, but not just rising temporarily. They're rising in a way that's going to have a lasting effect, and then they'll start to pour production capacity back out there.
All right. Well, ending with a little lesson on the oil industry here, which is always good. And Brett, like you said, we didn't even really get into any of the phase three trials, which a lot of them are due in that November timeframe. Just highlighting how risky of a time, both to the upside and downside, the end of 2020 is going to be, and what's really going to go down as a historic year in the markets and world and everything. It just feels like so. All right, Brett. Always a pleasure talking to you about all this stuff. Looking forward to our next show, which we'll be able to do a little bit of a follow up on what's going on with the dollar and seeing if there's any change in the sentiment. And hopefully, we'll have a fiscal plan that we could at least give some discussion around. But Brett, you
Certainly.
you take care of yourself, buddy. And
Okay, you too, Gav.
this for anybody listening, this is being recorded, so we'll be posting that after the bell. And if there's any questions, feel free to fire in, and Brett and I will answer them as they come in. All right,
Got
talk
it.
to you soon, Brett.
Okay, take care. Thanks, Gav.